The RSI, or Relative Strength Index, is probably one of the most misunderstood technical indicators out there. The most common thing taught to beginner traders about using the RSI is to simply look for reversals when the RSI enters overbought or oversold levels. However, with any actual experience using the RSI this way, you'd know that you'll end up deeply in the red trading like this. In today's video, we will explain what RSI actually is while offering some better ways of using this indicator. The first thing to understand about the RSI is that it is a momentum indicator that measures the speed and change of price movements. The RSI value ranges between 0 and 100 according to the level of momentum in a market, with levels above 70 indicating overbought conditions and levels below 30 indicating oversold conditions. When the RSI is at either extremes, it typically indicates very strong bullish or bearish momentum. However, you shouldn't rely on this alone to predict when prices will reverse. It just shows the current trend's strength, because bullish momentum is at its highest at overbought levels, and price is likely to spike even higher before reversing, and vice versa. The late 2020 period of Bitcoin's price action is a great example of showcasing this. From mid-October 2020, the RSI on the daily Bitcoin chart spent most of its time in the overbought region, all while price went up and up for months. A better way to identify reversals using the RSI is to look for divergences occurring at its extremes. An RSI divergence occurs when price moves opposite to the RSI, hinting at a potential change in momentum of a market. RSI divergences can be bullish or bearish. A simple starting point to understand divergences is when there is a contradiction or opposition in the way price moves versus what the indicator is suggesting. For instance, a bullish divergence forms when the RSI first enters the oversold region, followed by a higher low, while price forms at a lower low. This suggests a rise in bullish momentum despite price forming a new low. Meanwhile, a bearish divergence forms when the RSI first enters the overbought region, followed by a lower high, while price forms a higher high. So this hints at an increase in bearish momentum despite price making a new high. Another important consideration for divergences is whether they are following the overall trend or are counter trend. As the saying goes, the trend is your friend. Divergences that are following the overall higher time frame trend, such as a bullish divergence forming in an overall uptrend, tend to have potential for bigger moves towards the upside. On the other hand, divergences that go against the trend, such as bearish divergence in an overall uptrend, will typically have smaller moves towards the downside while also being more likely to fail. Another observation that can be made on the RSI is that it tends to stay above the 50 level during uptrends and below the 50 level during downtrends. So from this, you can think of the 50 level on the RSI as a form of reset or cool-off level for a trending market, where it could signal a potentially decent level to join in on a trend. However, the caveat here is that the signals from the 50 level can only be useful when the market is in a trend. When a market is consolidating or ranging, the RSI tends to chop around the 50 level with price moving sideways. In this scenario, entering positions based on the 50 level can be really detrimental, as it would lead you to enter positions usually at the middle of a range, which is the worst entry you can get in a ranging market.
I need to go out of this trading position, otherwise I will lose all my money.
To trade a range-bound market effectively, you want to be selling near the top of the range and buying near the bottom. And this is where using the overbought and oversold levels of the RSI can actually be useful, especially when combined with other analyses like support and resistance levels. For example, let's take a look and analyze the support and resistance levels on the 12-hour Solana chart in 2024. Here, you'll see the major support and resistance levels. For context, these price levels have historical significance as these levels were defended over a year back in 2021 and 2022. Price interaction with these levels had resulted in big upward and downward moves till the eventual loss of both levels, which was followed by a year-long sell-off. After waiting for the first interactions with these levels to occur in 2024, let's look at how the 70 and 30 levels on the RSI can be used in conjunction with support and resistance levels. By circling out the points where price taps into the levels, you can see that these coincided with RSI hitting the 70 and 30 levels. So this is an example of where RSI overbought and oversold levels can be useful. You can see that the points marked out have for the most part turned out to be really good spots for buying and selling. However, the support and resistance levels of a range do not stay static for the most part. If you look closely, you may notice another resistance that has formed around the middle of the range. Using the same rules as mentioned before, you can observe additional instances where one may have taken profit on buys or even enter shorts. It's also worth mentioning that the benefits of using support and resistance levels with RSI is not limited to only when RSI is in overbought and oversold levels. On the same chart, there's also an example of a bullish RSI divergence that occurred at the support, which had a good playout. This also applies to the RSI 50 level for joining in on a trend. In this example, the market initially had an uptrend, then was followed by a consolidation phase. A bounce off of a previously interacted price level confirms it as a support level, which subsequently was lost during a dip below it during consolidation. Afterwards, however, price reclaimed the level as support by trading back above it, with RSI going above 50. Then price dips back into the support while the RSI dips back into the 50 level. This signaled a buying opportunity, which was followed by a wonderful playout in this scenario. Like most other technical indicators, RSI has better results when paired with other forms of analysis, which of course is not only limited to support and resistance levels. For example, it could be price action, moving averages, volume analysis, and many more. Just keep in mind that there is never a perfect form of market analysis, and always test your ideas over and over before deploying live. Besides that, if you choose to use RSI or the tips that I mentioned earlier for your trading, it's important to remember that trading is very personal. If you dislike RSI, don't start trading with RSI just because of a video on YouTube. Whether you're using it or any other indicator and analysis method, use it in a way that suits your trading. Hopefully, these tips provided you with some valuable insights in using the RSI in a more productive way. If this video helped you out, leave us a like and subscribe for more future content, and I'll see you in the next video. Bye.